All right, give me about 8 minutes and I'll show you how to add 3 winning trades next week. But before we go any further, I need to clear something up, right? This isn't about signals. It's not about lots, and it's definitely not about trading more just to feel more productive. Because most traders, they already have enough opportunities in front of them. And the problem is what happens between seeing an opportunity and actually executing it. And honestly, most traders, they don't lose because the market isn't giving them chances. They lose because things slowly start getting complicated. And once that happens, hesitation starts to creep in, and hesitation turns into overtrading. And overtrading is how you end up taking trades, if you're being honest, weren't really aligned with your trading plan. So you trade without any confluences. So generally, when people talk about adding winning trades, the answer is rarely something new. It's usually about tightening decisions. That sounds simple, and it is, but it's not easy. And the goal here, we're not seeking perfection. What we're seeking is consistency. And to understand this better, I've divided it into 3 pillars. So we're going to go through that one by one. Now, the first pillar is less is more. You hear that quite often, right? But what does that actually mean? One of the biggest shifts I see, when traders start improving, they start doing better, is when they finally accept that trading less can actually make them better traders. So you don't need more trades. You need fewer trades that actually make sense. Most bad weeks don't happen because price didn't move, because price almost always moves. But they happen because trades were taken in noise. Because moments where nothing was really lined up, but a trade was taken anyway. I'm talking exactly about that scenario. And that noise usually comes from when too much is going on. Now, what I mean by that is if you're watching too many pairs, you have too much going on at once, it just creates noise. When you stick to 2 or 3 assets, you actually start to understand how they move, where they like to induce, or which levels they usually respect. Getting familiar like that makes trading feel calmer. You're more natural, and it's always better to know a few pairs deeply than to watch everything. Because you know that saying, jack of all trades is master of none. You don't want to be doing that. The second most important thing that I see is having too many indicators on the chart. Because too many indicators that look helpful, but realistically, they don't change whether you should be in a trade or not, should never be on your screen anyway. Because if you're relying on indicators to tell you when to buy or when to sell, you're doing trading completely wrong. Do not add meaningful information to the decision-making process. So just get rid of it. When you have these first 2 ticked off, what happens is you need to then pay attention to the key levels and price action. And that is where liquidity starts to matter more than indicators. So instead of reacting to, every little move that the market is giving you, what you're doing is basically you're thinking about where liquidity is likely resting and how price has behaved around those areas before. Whether price is actually being delivered there with intent or it's just drifting. These things would be better understood through price action and paying attention to the key levels. And this is where top-down analysis, finally starts to make a bit of sense as well. Because when I'm talking about price action, what I mean by that is your higher time frame will give you context, will give you the direction, will give you the structure, where the bigger liquidity pools are sitting. You can actually drive a narrative, drive a story about whether the price is going to go up or down through understanding that. And when you go down the time frames, when you go on the lower time frames, they aren't there to tell you what to trade. They're there to help you execute once the idea of the bigger picture, the higher time frames and the middle time frame makes sense. So the price action is a key element in this. So now talking about the last one here. So now when each time frame has a job and you're aligned with liquidity instead of fighting it, you stop trying to predict what price should do and you start waiting for price to show you what it's doing, so you act accordingly. So instead of you predicting, you're actually reacting to whatever the price is giving you. And when you strip all of that back, really strip it back and focus on 1 or 2 pairs, keep the chart clean and only work with real confluences that actually matter, decision making becomes simpler. Not easy, but simpler. And that's when you start making money. Moving on to the second pillar, a lot of traders that I come across that are at the start of the trading journey, they think they have a confidence problem. But the reality is that it's actually a clarity problem. And most of the time that is the case. If you're still thinking while, price is moving fast, you're debating, you're hesitating, you're going back and forth, you're going to end up doing things that are outside the plan. You're going to let feelings override whatever your trading plan is. And that could be in the form of FOMO. So every move starts to feel like the move. Then what happens is greed shows up when you stop following your plan and start chasing what price might do. And then it ends up usually with revenge trading. And revenge trading usually comes after a loss. When you're trying to get back what the market just took, that's when you go in a spiral. Instead, what you should be doing is thinking like a professional trader. Because a professional trader, they're not deciding in the moment. They already know what they're waiting for. They know what needs to be present, what invalidates the idea, and when walking away is the right decision. So they already have a predefined plan that they follow to the T. That's why missing trades don't really affect them. Missing a trade because your conditions weren't there isn't failure. right? I want you to understand that that's actually discipline doing its job. Now, moving on to the final pillar, which is basically risk plus confluences equals to control. Now, once your confluences are clear, risk, honestly, it starts to become very easier to manage. You don't need to be right more often. You just need to, behave better when your setups are actually showing up. Because most low probability trades come from entries with no real confluences. You don't have the market really telling you whether you should be bullish or bearish. There's no structure, no liquidity story, no alignment, just clicking because the price is moving. And at that point, let's be real, that's not trading. That's actually you gambling. So when your risk is, predefined, when you know how much you're going to risk in every single trade, when your profit taking is structured, there's a lot less emotion in the moment. You don't end up negotiating with yourself while price is moving because the decisions were already made. And when that starts to happen, that's when small, repeatable wins, they start doing the heavy lifting, especially when they're coming from the same type of setup again and again. You can have a pretty average read on the market and you can still finish the week green just because your execution was clean. And again, that's not luck, that's structure. Simple, not easy, but very, very simple. And if you're listening to this thinking, okay, I see where I've been overcomplicating things, that's exactly the work I do in my one-on-one mentorship. I work with traders individually to clean up their process, review each and every trade they're taking, and help them build rules they can actually follow. It's not signals, it's not a shortcut, it's structure and accountability. And if you want that level of feedback, there's a link below where you can apply. Now, having understood the 3 pillars, let's see what actually, a strong, productive trading week actually looks like. When I say strong, productive, I don't mean a green week, because you can actually take good trades that end up as losers and vice versa. You can actually take bad trades that turn out to be, winning trades. But does that make them valid to be taken every single time? Absolutely not, right? So there is a bit of a proper structure that you need to follow to finish off the week strong. Now, what I mean by a good trading week is definitely not 5 green days. It's not catching every move. It's basically starting the week with clarity and not bias. You're not forcing your narrative on the market thinking that it has to do this. You're actually understanding whatever the price is giving you, and then you're actually driving a narrative through that. So you start with clarity. The second thing that you need to do is you trade during the session that matters. You don't just hop on the chart at a random time trying to catch a move. You trade fixed sessions. That could be a London, New York AM, and New York PM, or even Asia session, and that should be your daily window that you trade. The third thing that you need to wait, and this is one of the most difficult things to do, because 90% of the trading is just sitting on your hands and waiting patiently for your setup to happen. So you wait patiently for the price to come into your levels. It could be a higher time frame or a middle time frame point of interest that you're waiting for the price to enter. Now, the next thing is you only trade when clear confluences are present. So liquidity sweep and a point of interest tapped into, that's when you're going to move on to lower time frames. And the lower time frames will always align to whatever the higher time frames are saying. It's not going to actually start printing a new narrative, a new story altogether. It's usually just refining whatever the higher or the middle time frames is showing you. And you only execute when the lower time frame conditions confirm what you've already been looking for. So once that ticked off, then the last thing is consistent management. Risk is managed the same way. Every time you enter the market, it's going to be looked at the same way. And some days you're not going to be trading at all. This might sound boring and intentionally boring, but that's the whole point, right? Because consistency isn't built through activity. It's actually built through filtering and knowing when to enter and actually knowing when to sit on your hands and not do anything. And when I say add 3 winning trades next week, I'm not telling you to trade more. I'm telling you to trade cleaner. Because 3 winning trades, that usually comes from a better process, more patience and fewer mistakes, not from chasing green days or forcing trades. And honestly speaking, a lot of the time, the biggest improvement comes from the trades you don't take. So you don't need perfection, you just need consistency. And that's it for today. I'll catch you in the next one.